All right, guys, thank you for coming. Thank you for showing up for this tax class, right? I know it's not the most fun topic to learn about, but it's a very important topic. And who better than one of my best friends? He was my college roommate all 4 years. He's very good at what he does, and he happens to do taxes. So he works with traders, he works with larger companies um, over here on the East Coast. But I think he's got a lot of good stuff to show. He came more prepared than I ever do for class, right? He's got a full presentation for us. So um, this is Alex Adams. He's got a lot of good information to share with us, and he is our tax strategist for opportunity trading. So anybody that's in the Signals membership, the tab that says OT tax strategist, you guys can message him at any point if you need information from him or have questions, stuff like that. He is there to answer anything you got. Well, but this is Alex Adams. Take it away. And he's surfing in the Discord, by the way. Go ahead.
All
I'll,
right. Well, it's good to be here. Thank you guys for showing up. I got this little presentation for you guys. Should be some pretty basic topics. Most people should be able to kind of understand this. So we'll get started. Um, so a little bit about me. I know you guys probably haven't you guys probably don't know too much about me, but I was born in Charlotte, raised here in Lake Norman. That's where I currently live now. Like Brad said, we went to UNCW. I got my degree from the Cameron School of Business there. And I do work for a very small private accounting firm, which is called Glenn R. Luisi Accounting, the logo down there at the bottom. You can search us up on Google if you're interested in anything. Our website should pop up pretty far up there at the top. I am currently a candidate for the CPA exam, so I just took the first section a few weeks ago. Still waiting on my score, but so hopefully all is well with that. Um, just some personal stuff. I am super into fitness, cars, video games, bunch of sports. Uh, and fun fact is that I swam for the same organization as Ryan Lochte, who's a Olympic gold medalist. I was not on his team, but I was a couple divisions down, so still something pretty cool. But all right, let's get into the meat and potatoes. So, big thing that you guys are probably thinking about is capital gains and losses. It's probably one of the biggest or most spoken about topic when tax and trading come together. Um, and I do want to point out you're supposed to report any gains and of course any losses. That always helps you out, but you're supposed to report anything that you do that involves transacting money with securities or pretty much anything else. Um, and all of this will be reported on Form 8949 on your tax return. And yeah, 8949 is used to report gains on any capital assets, not just securities. Um, anything, anything that you hold more than 1 year is considered long term, less than 1 year short term. Um, if you incur losses on sales of assets, the amount of excess losses you can claim to lower your income. Now, I want to make you clear, this is not a tax deduction. So this isn't going to say if you owe like, $5,000 at the end of the year, this $3,000 isn't going to lower that to $2,000. This comes off of your income. So that'll just, your whatever tax bracket you're in, that percentage will, be multiplied against whatever you made minus $3,000. And for like very specific situations, some people, who are married, they'll file married filing separate. We've had a few clients this year do that. It's just sometimes that works out better for some people. And that really comes into play like when both the taxpayer and the spouse have a lot of stuff going on, just them themselves. Say the wife has a business, husband works for big company, things like that. So if your losses exceed $3,000, you know, that $3,000 limit, you can carry that forward to, you know, however many tax years you want to, um, until, you know, until all those losses are, you know, kind of used up. I've seen that that helps people a lot, you know, kind of just, it really just helps people, you know, lower their tax liabilities. Um, and then so tax rates, so usually, you know, what most people are going to be looking at for capital gains is 0 to 15%. 0% affects incomes ranging from 0 to about 40 grand for single filers, you know, 84,000 for married filing jointly. And then if you're making some big money, um, you know, it's 15 going up from there all the way up to about 500,000 for both. Then anything above that is going to be taxed at 20%. And for very, very special occasions, it can go up to 28%. But that's, you know, usually won't see that. And if you're wondering where this is going to show up on your tax return, it'll be on Schedule D. And that's usually, I would say, probably a couple pages down from the 1040. 1040 is usually about 2 pages. So some of the basic stuff right there. Now, this is something that maybe you've heard about these. Still kind of a basic concept, but still with even with some of my clients, a lot of people don't really know kind of what's going on with estimated tax payments. So if you expect to incur capital gains frequently year over year, paying estimated taxes is definitely something that you want to start thinking about. Or if you don't want to pay estimated tax payments, you just really need to make sure that you have a lot of money saved up if you're making some big money. You know, because you don't, you know, nothing forces you to pay tax throughout the year on these capital gains. So you definitely don't want to be that guy who, you know, come tax time, you have a big tax bill, and then you get mad at the accountant because you owe so much money. So these are really important. If you see this as like a common theme, definitely ask, you know, whoever's doing your tax stuff, CPA, registered agent, definitely ask them about this. They can set you up with that. So these will usually be paid on April 15th, June 15th, September 15th, and then the January 15th of the next year. So April 15th, you know, obviously that's for first quarter, June 15th, you know, and so on. You know, again, estimated taxes will severely reduce the amount of tax liability that you have come tax time. So this is kind of like, you know, quarterly paying off or quarterly preparing for April 15th if you know you're going to owe. And you can pay these by either Form 1040 ES by mail. You know, we have that's usually for, you know, people who are a little bit older. Um, I think we have a couple clients who, you know, we'll print these out every year and send them to them in the mail, and they'll mail a check in. Or you can pay it through the IRS website, which is they've made that super easy. You just go to the IRS website, go up to the pay tab up top, click on it, enter in your information, and just pops up. You can pay with debit card, credit card, whatever you want. And obviously, so these are available to any individual, S corp, sole proprietors, partners, really anybody. There. So this is one of the kind of more in-depth topics that I wanted to talk about. I have maybe one or two clients where I've seen this show up on their tax returns. It's called net investment income tax. And so this was imposed by Section 1411 of the Internal Revenue Code, and it applies at a rate of 3.8% on net investment income of individuals and estates and trusts. And I don't think we're really going to see estates and trusts too much. I know me and Glenn try to kind of stay away from those because it's just a big old hairball of stuff. We did one a couple years ago, and it was a lot. But those are, you know, pretty rare situations. So the limits or the thresholds are 250 grand for married filing jointly, 200 grand for single filers, and these are not indexed for inflation, so they don't adjust with the dollar value. So net investment income is, this is kind of a definition. It's income from interest, dividends, capital gains, rental and royalty income, income from businesses involved in trading of financial instruments. So anything really with capital gains that I was talking about before. And I got a couple examples for you right here, because I know this is kind of a weird one, but so say for example, there's a taxpayer, single, has wages of 180 grand and 15 grand of dividends and capital gains. Their modified adjusted gross income is going to be 195,000, which is less than the 200 grand. So they don't have to worry about that. But in the same situation where they're a single filer, 180 grand of wages, and they received $90,000 from a passive partnership interest, which is, it's just interest income. Going back up to the definition, that is considered net investment income. So their modified adjusted gross income is going to be 270. And since that's, above the 200 grand limit, tax is going to be paid on that 70 grand. So you should expect about 26,600 net investment tax, or net investment income tax. I don't know if a lot of you are going to be seeing this. I hope you do, because that means you're making a lot of money, and that's a good thing. It just kind of sucks that they have another little tax in there to squeeze in there for you. Right, so this is a little bit more of a, this is kind of a controversial topic almost, but definitely a little bit easier to understand than the investment income tax. I've heard a lot about reinvesting dividends that you receive, just from big companies that'll pay you out. Like for example, like Coke or Publix. I have a few clients who every year I'll see a 1099 div from them that's got, a few $100 of these dividends that they receive, because either they worked for them, or they invested, something like that. So dividends received from a large or successful corporation can be cashed out or reinvested back into the company for more shares. But if you receive these dividends and then reinvest them, you still have to pay tax, when you receive them, as you would if they were cashed out. And a big question here is, are they qualified or ordinary dividends? Now, qualified dividends are going to be, strictly from American corporations, like here in the US. And there's a few other, kinds of like IRS requirements that they have for dividends to be qualified, but those kind of get, super in depth. But qualified dividends are going to be more favorable because they're tax to capital gains rates, which are a lot lower than ordinary income rates. I think, yeah, so going back to, the first slide where we had 0, 15, and 20, those will be those rates that you get for qualified dividends. So this does include any dividend reinvestment plans in which you participate. So DRIPs allow investors to purchase additional shares of stock at below market prices. In these cases, the difference between the cash reinvested and the fair market value of the stock is taxed as ordinary dividend income. So that'll be at the higher rates. But something I did want to point out is that some companies do not offer investors the option of taking the cash, and it's for the sole reason of, almost kind of paying tax twice on what you receive. But so instead they'll pay you out in the form of additional shares. So that'll, I guess the best way to describe it is, this is only one, like there will only be one transaction, like concerning hard money, basically. These additional shares, they're not taxable when received, but when you sell them, they are. So yeah, that is little information on reinvesting dividends. So the next topic I wanted to cover was the wash sale rule. I'm not sure if a lot of you guys have heard about this, but it's something that I think I heard about this a few months ago. Maybe back in tax season, when me and my boss were talking about some stuff. Because we noticed there's one of our clients, he lost a lot of money in Dogecoin, which kind of sucks. That's kind of one of the suckier ones to lose a lot of money on. But this kind of came into play with him. So the wash sale rule is an IRS regulation that prevents a taxpayer from taking a tax deduction for a loss on a security sold in a wash sale. So a wash sale occurs when you sell or trade securities at a loss, and within 30 days before or after the sale, in total, this is going to be a 61-day period. You either buy substantially identical securities, acquire substantially identical securities in a fully taxable trade, or acquire a contract or option to buy substantially identical securities. So this happens, this happens a lot. So the point of this rule is to prevent investors from creating an investment loss for the benefit of a tax deduction while basically maintaining their position in the security. So really what, this prevents is just creating artificial losses to help you out tax-wise. So though a loss may be disallowed due to the wash sale rule, the amount of that loss will be added to the cost of the purchase that triggered the rule. Then when that position is later sold, any loss that occurs can be taken as a tax deduction. So therefore, the original loss can be said to be deferred. So that first loss that you take, that you can use that to your advantage, but really anything after that is, can't really do much. But I will be kind of revisiting this back at the end of the PowerPoint because this is strictly for investors and not really like day traders. So a little more on this just to kind of expand on it and really kind of try to help you guys understand. This does apply to options as well. Like I said earlier, the sale of options, which are quantified in the same way as stocks, at a loss, and reacquisition of the identical options in the 30-day time frame would also fall under the terms of the wash sale rule. So not just buying and selling stuff. This has this comes into play with contracts. And so I have a little example here. So say you buy 100 shares of GameStop stock on November 1st for 10 grand. On December 15th, the value of these 100 shares has declined to 7 grand. So you sell the entire position to realize capital loss of three grand for tax deduction purposes. On December 27th of the same year, you purchase 100 shares of GameStop stock again to reestablish your position in the stock. So notice that December 15th, December 27th, that's only a 12-day window. The initial loss will not be allowed as a tax loss since the security was repurchased within the wash sale rule timeframe. Instead, it will be added to the cost of the recent purchase. And then when you do sell those recently bought shares, the adjusted cost basis will be used to figure your gain or loss. So a little confusing there, but you guys are more than welcome to come back to this video. I know Brad said he's going to put it up on YouTube. So if you really want to come back and look at the example, I think that'll be a good reference point if anybody kind of comes into this situation in the future. And I see a question. So wash sale, this only applies to one the same stock only. Yeah, so pretty much. I don't know, I don't really look at stocks a lot, I'm not gonna lie. So if it is the same, pretty much like say GameStop, if you buy more GameStop, yeah, that's gonna be the same stock. But say if there's another video game shop or whatever, EB Games or whoever, that wouldn't be treated as a wash sale because it's still a different company, even though it's just in the same industry. But, all right, so moving on to the next topic, trader tax status. Now, I kind of looked into this because I figured, this would be pretty important to you guys, especially, you guys who trade daily, and this is kind of, or that's kind of like your main thing or your main income source. So the trader tax status is, these are special rules apply if you're a trader in securities, in the business of buying and selling securities for your own account. The law considers this to be a business, even though a trader doesn't maintain an inventory and doesn't have customers. So the requirements for this kind of status is you must seek to profit from daily market movements in the prices of securities and not from dividends, interest, or capital appreciation. So this is really, this is really just from trading securities like only. So you're, like I said, your activity must be substantial. So it's probably going to be, the only thing that you do for income. And you must carry on the activity with continuity and regularity, which basically means, you do this year after year. And again, this is like, trading is your main thing. So some more on this trader tax status stuff. So the TTS requires approval from the IRS. So you can't really just kind of, go on their website and be like, hey, I want to, be, I want to be considered trader to get this tax status. So you're going to have to alert the IRS of your intention to file under the trader tax status by making a mark-to-market election in your tax return for the year prior to the year that you'll actually receive the trader tax status. So, if you're thinking 1 year you want to, this is something that you want to do, you're going to have to plan for this to kind of come into effect for the next year. And and to make this election, the IRS requires that you attach a statement to your tax return that includes the declaration that you're making an election under Section 475F. They're also going to need to know that, or which tax year is going to be, the election where it's going to be effective. And then the type of trade or business that you're making the election for. So, if you're trading stocks, if you're trading, I think you can trade like farm securities, stuff like that. So yeah, that's the trader tax status. I think that will, I think that this is kind of a big thing for you big day traders. So if you're really interested in this, you could consult your CPA or your tax preparer, whoever. And for your situation, they should be able to tell you if this is a good thing for you. All right. Our last slide. I know this is probably some of the stuff that everyone wanted to hear because this is, deductions are really what save you money with paying tax. So trader tax status comes with a number of benefits, including the ability to deduct interest as an expense. So really, like Schedule C businesses, I don't think you really can deduct interest expense. I really haven't seen it, unless if there's some weird loophole that you can get through. But normally, if you're just a normal person running a Schedule C business, you really can't do that. So traders can also deduct educational expenses, like stock trading seminars, educational materials, and provided that these expenses are itemized. Which really that means if these expenses, so yeah, these expenses, well, really what itemized means is that you're going over your standard deduction. So I think this past year, the standard deduction for single people was 12,950. So if you're, if you have expenses that fall into these, deductions that are allowed. If you have expenses that go over that number, that's what itemizing means, is, you're taking more of a deduction than what the IRS already gives you. And then another big thing is if you work, if you work from home, you can take a home office deduction. So what this will, kind of require from you is you're gonna need to know the square footage of your home office in comparison, like, to the rest of your home, because that's gonna be a percentage of some expenses, maybe utilities, if you have a bathroom in there, possibly water. Um, but yeah, that's another big deduction. And all these deductions are listed on Schedule C on your tax return. So this will kind of be in the same area as Schedule D. But yeah, so, and really the deductions, for traders, I mean, it could be a lot. Anything that is directly related to your course of business. I mean, even like office supplies, pens, pencils, paper. If you use paper, print out and send to clients, or whatever. Like an office chair, like a desk. These, all of these things are directly related and directly impact your course of business. So you'll be able to kind of work out, some numbers from those to lower your tax liability. And so the trader tax status also allows day traders to make an election for something called a mark to market. When I was talking about earlier, a day trader who does not have a trader tax status can only write up to $3,000 in trading losses when they file taxes. So like that $3,000, capital gain limit that I was talking about earlier. But those with mark to market election can claim greater losses if applicable. I know that kind of gets in depth too. So if you're looking to do that, definitely, consult with whoever your tax preparer is. Because there's, once you kind of go down this rabbit hole, there's going to be a whole another rabbit hole waiting for you with, other, what am I trying to say? Kind of like other, other things that, need to come into play to make that right for the IRS to see. And the mark to market election can also eliminate the application of the wash sale rule. So if you're, a trader, full time, this can really help you out with, I guess it'll really help you out with sorry, I was looking at a question here. Can you explain so Kelly asks, can you explain expenses exceed 2% of AGI? That seems like a lot of money to spend up front to get to the deduction. So really like what I want you guys to take away from that is the itemization. What I was talking about, the itemization is going to be, anything. It's going to be anything above the standard deduction. So that's really what you want to look for. The 2% of AGI, to be honest, that can come into play sometimes. But really what you're going to look at is the, these itemized expenses going over standard deduction. So yeah, no, I hope you guys kind of found this information helpful. Tried my best explaining to you guys. This is the first time I've really taught a tax class, so I hope you guys liked it. Got a little throwback here for you. So yeah, if you guys have any more questions, like Brad said, put them in the Discord channel under the OT tax strategist. Yeah, I'll try to help you guys out as much as I can. So
I appreciate it, Alex. Thank you. One quick question about the tax deduction stuff. So they can write off this membership too, the membership fees that they pay.
Yeah, because this is educational.
Yeah, I just
So
want to make sure everybody knew that so they can do that this upcoming tax season. But
yeah,
thank you. Awesome information. Really appreciate you making the time to come talk to us about this. Like he said and I said, if you have any questions, go to the OT tax strategist section. I know you guys will be pretty full, or he will be pretty full once tax season rolls around, and I'm sure you guys will have a lot of questions for him. And hey, if you're looking for somebody to do your taxes, he's your guy. So just message him in the chat, message him. You can DM him directly or through the tax strategist channel, and he'll get back to you with any questions if you want to use him as a to do your taxes.
yeah.
I'm sure he'd be more than happy.
If you guys have, if you guys need the office phone number or any of the emails that we use, um, just let me know in the Discord channel, and I'll throw our office number down there, or any of the emails, and that'll be the way that you can get in touch with me.
Cool. All right. Thank you. Have a good rest of your night, guys. Anything else from you,
Yeah,
Alex? Good.
no, that's it.
All right, cool. Really appreciate your time. All righty. Have a good
Yeah,
night, guys.